Good afternoon, everyone. Welcome to another segment of our Friar Financials Financial Forum. Today, of course, we'll have our usual segments, the Markets in Motion, Finance in Focus, and the Wealth Wisdom Workshop. And today's Wealth Wisdom Workshop, we'll talk a little bit about real estate investing. But let's get us going. First section, I should say, is Markets in Motion, and we'll get started. So Jeff, this was one of those weeks where the headlines hit you before the coffee did. Uh,
Mhm.
the Iran situation just kept evolving, even with most of their Navy knocked out. They're out there still using these tiny fast boats to drop mines in that Strait of Hormuz. And honestly, that's all it takes to kind of that global shipping. People are kind of scared to go through that strait. So as we're seeing, they don't really need a big Navy to create some big problems, and they know it. So Iran's basically saying, if you want to talk, you're going to do it on our terms. And even in their weakened state, they can still kind of shake this global economy pretty hard.
Yeah. I mean, meanwhile, Washington is, doing well, Washington things. You got different groups inside the White House kind of pushing different exit strategies. Then you hear reports that the president told G7 leaders Iran is close to surrendering. But intel folks are saying pump the brakes on that. And then we got the Treasury Secretary Bissett. He jumps in saying that the U.S. will start naval escorts in the Strait as soon as it's military doable. But analysts are pretty blunt. Even if we release oil from the reserves or give shipping waivers, it's not going to magically bring fuel prices down either, though.
Yep. And those pressures are showing up everywhere. I mean, Gulf states have already lost something like, what, $15 billion in revenue.
Hmm.
Qatar's LNG halt doubled helium prices, which sounds like a party balloon problem, but it hits things like MRI machines, chip making. I mean, all kinds of things. And then so China's even got a stockpiling strategy is being tested. So Europe doesn't have much fiscal room left in their vault to cushion another shock, and analysts just keep revising oil forecasts higher. So heating oil here in the U.S. is at multi-month highs, and Russia, they're making an extra $150 million a day from these higher crude prices.
And all that rolls right into the markets. I mean, Treasury volatility hit a 9-month high. Rising oil prices are threatening to wipe out the bond market's gains for the year. And then crypto is doing what crypto does. Ultra short-term traders are amplifying every move. So then we got the consumer sentiment that finally blinked. And after 29 straight weeks of positive readings, one of the longest streaks ever, by the way, the composite slipped. And then investors are kind of watching kind of credit default risk like hawks right now. So.
Yeah, that private credit. Yeah. Taking on that.
Mhm.
So yeah, it's just one of those moments where the geopolitics combined with the energy and the markets, they're just all colliding together. And when that happens, consumer confidence shifts pretty quickly because people get nervous and run to the sidelines. So we'll take a short break and we'll be back with our next segment, Markets in Motion.
Retirement doesn't mean lower taxes. In fact, for many retirees, tax pressure increases. Required minimum distributions, taxable Social Security benefits, Medicare surcharges, and rising healthcare costs all combine to create a growing tax burden over time. Longer lifespans mean more years exposed to that pressure. That's why Friar Financial builds dynamic retirement income strategies designed to manage taxes proactively so more of your money stays yours throughout retirement.
All right, we're back from our break to begin our next segment, Markets in Motion. I'm sorry, not Markets in Motion. We just finished that one. Finance in Focus. So let's zoom into the actual market action. We just wrapped up our third straight down week, and the big drivers were pretty clear of the down week in the market. Middle East tensions, oil volatility, and kind of a handful of economic updates that kind of kept investors guessing. So Jeff's going to kind of jump into those things.
Yeah. And so it was choppy across the board. The S&P 500 slipped about 1.6%. The Nasdaq was down about 1.26%. And then the Dow fell almost 2%. Overseas markets dropped a little over 2% as well. So a little bit choppy all around. And this week started with a jolt, though, with commercial ships stuck in the Strait of Hormuz. Oil prices jumped and stocks opened sharply lower, but by late Monday, markets bounced back after the White House hinted the conflict might wrap up sooner than expected. And then Tuesday gave us another dip in the open, but things steady. I once talked about surface about a coordinated release of strategic oil reverses. And then midweek, we got a breather when the consumer price index came in unchanged. Always nice to see inflation behaving, even if briefly. So,
Yeah, that's always helpful. But it didn't calm us down for long because oil kept climbing, hitting all-time closing highs. And again, that pushed stocks lower. So investors started worrying about that prolonged supply issue could spill into the broader global economy if that continues for some time.
and you can see that in the bond market. So yields rose as investors priced in the possibility that higher oil prices might keep inflation elevated. And then by Friday, sentiment was still cautious. So especially after a downward revision to Q4 GDP, but the pace of decline slowed.
Okay, gotcha. So let's shift gears a little bit and let's talk about the corporate and tech world as it had its own drama this week. So Meta's delaying its new AI model, which is named Avocado. No official explanation, but in a race this competitive, delays always kind of raise your eyebrows.
And Oracle, they're having a moment. On one hand, they're increasing their restructuring budget by another 500 million, and that's mostly tied to the AI related workforce cuts. And then on the other hand, they're offering free AI features to customers to boost slowing SaaS growth or SaaS growth. It's like they're hitting the gas and the brakes at the same time. Adobe's also in transition. Their CEO is stepping down after 18 years. And then investors are wondering whether the company's AI strategy is keeping pace with the rest of the field. And then we got Apple, and this one surprised me actually. They're cutting App Store commissions in China after regulatory pressure, and that's a big shift for a company that rarely budges on fees. So that's something we rarely see.
Oh, yeah. Wow, that's definitely different. Meanwhile, in the EV world, Tesla's China made sales are surging in early 2026, and they're outpacing BYD's decline. And I was not familiar with BYD because it's not a vehicle that's over here in the United States, but apparently it is a huge manufacturer of EVs because they've been the heavyweight in that market for quite some time.
Yep. And then energy is still the backdrop to everything. So Europe's running low on fiscal room to cushion another price shock. And then here in the US, there's a growing debate about who should pay for the massive energy demands of data centers, especially with the AI workloads exploding. Yeah. So with that being said, now Marcus, while everyone was watching the Middle East headlines, we actually got some economic data that might have slipped under the radar.
Yeah, we did. So midweek, the CPI report showed inflation was flat over the past 12 months. So that was a welcome sign. But it's also the last inflation reading before the conflict began. So markets didn't put too much weight on it because of the delayed reporting from the partial government shutdown, kind of delayed that information. And so they kind of shrugged their shoulders at it. But then what happened
Hmm.
uh, on from there?
Yeah, and then on Friday we got the personal consumption and the expenditures index, and then the Fed's preferred inflation gauge. Prices were still a bit sticky in January, but because the report was delayed, investors mostly shrugged it off. And then as we look ahead, here's what we got on debt. So we got Monday, you got the industrial production economic data, and then we got Tuesday, we got Fed meeting begins. We got the pending home sales, and we got the home builder confidence. And then on Wednesday, we got the Fed meeting day two, factory orders from January, and then a Fed interest rate decision. So important day on Wednesday. And then Thursday, we got weekly jobless claims, wholesale inventories from January, and then new home sales from January as well. And then on the earnings front, just a couple to watch this week. Wednesday, we got the Micron technology, and then Thursday, we got FedEx. So a big couple big dogs.
Yep, wrapping up the end of the quarter. So a lot of
Hmm.
moving parts this week, especially with the Fed meeting. That's going to be interesting to see what they're going to do. So Mark will be watching that closely to see how these policymakers interpret this combination of geopolitical risk, these rising oil prices, and still a little bit sticky inflation. So we'll take another short break, and when we return with our wealth wisdom corner for this week, we're going to be talking about real estate investing. So we'll see you on the other side of the break.
Retirement shouldn't feel uncertain, it should feel intentional. The difference comes down to precise planning. From Social Security and pensions to investments and tax-efficient withdrawals, every decision shapes the reliability of your income. And when taxes are managed wisely, your money simply lasts longer. At Friar Financial, our dynamic retirement income strategy brings all the pieces together so you can enjoy a retirement that's not just secure, but rewarding.
So, welcome back to the Wealth Wisdom Corner. And I'm Marcus Fryer. And after the break, we promised to dig deeper into one of the most enduring wealth building tools available, which is real estate. So, we just hosted our webinar on real estate tax strategies, which is available for replay on the Fryer Financial YouTube channel. But before we talk about the strategy, it's important to understand the nature of real estate itself because the characteristics of the asset class kind of shape everything else. So Jeffrey's going to kind of lead us off with that in a second. But just understand, so real estate behaves very differently from stocks and bonds. It's not always easy to sell. Prices can vary widely from one property to the next. And that's mainly because there's no way to reach all the market of people wanting to buy. You can't advertise to every person. And so that makes it kind of a inexact market from that standpoint. And then the market itself can be slow and inefficient. And as we just said, since you can't reach all the available buyers, that makes it an inefficient market. On top of that, you got operating costs can make your income unpredictable. And that means investors need to be thoughtful, patient, and prepared. But when you understand these dynamics, real estate becomes a powerful long-term wealth builder. So let's not talk about how investors actually put this. So let's talk about how investors actually put this asset class to work.
Yeah. And so there are three classic approaches to real estate investment: buy and hold, fix and flip, and then rental income. Buy and hold is a long-term play, so you're letting the appreciation of the property do the heavy lifting. Then we're going to fix and flip, and that's a lot more hands-on. You're creating value through improvements and then selling those for a profit after you make the improvements to the property. And then you add in rental income, which is all about steady cash flow and long-term occupancy management. So managing those tenants and, like you said, having that steady cash flow, but also still having the property under your name as well. And then each strategy has its own time commitment, risk level, and return pattern. And then choosing the right one depends on what your goals are.
Exactly. Now, one thing we can add there, especially when it comes to that rental income, one thing
Hmm.
that we generally see investors do improperly is they are not raising their rents each year. And so they're actually eroding that to inflation. And the thing is, we expect if we sign a lease with a apartment complex, we expect our rent to go up each year.
Hmm.
What I find is that real estate investors tend to only like to be nice. And so they're like, well, I don't want to charge them more. They're a good tenant. Um, and so, it pays my bills. I don't have to pay for it.
Hmm.
And that's correct to a certain extent again, but with inflation, you got to realize when that oven goes out and the oven that cost $600 last year now costs $700 this year, and you didn't raise your rents, then you're cutting into your profit margin.
Hmm.
Regardless of the strategy, there's a few best practices that we want to talk about to help people be successful and not be frustrated in this journey. So think long term. Evaluate your real return, as we're just talking about, not just rent minus the mortgage. Pay attention to inflation. Also, you got to study these demographic and geographic trends. Where are people moving? Where are people moving from? So, as we said, being nice as a landlord only hurts your real returns in the end. So, in other words, again, be patient, be thorough, and be informed. So, next, we're going to talk about kind of the estate planning side of this and the tax management.
Hmm. Yeah. So now let's kind of, as we move into the part of real estate, well, let's move into the part of real estate that can dramatically change the outcomes, and that's the tax strategy side of things. So that's like tools like your 1031 exchanges, your Delaware statutory trusts or DSTs, then your 721 exchanges kind of allow investors to defer taxes, simplify the management, and also increase diversification at the end of the day, which is something we're always looking to do. So let's start with your 1031 exchange. And what a 1031 exchange does is it lets you sell investment property and reinvest those proceeds into another property without triggering a capital gains tax right away. So you're like you said, we're deferring that tax. And it's one of the most powerful tax deferral tools you can use. And then that kind of leads into our DSTs, a Delaware Statutory Trust. And then a DST allows investors to move from hands-on property management into a passive interest in professionally managed institutional quality real estate. And then simply put, you just letting it live. It speeds up closing and it opens the door to higher quality assets. You're taking a hands-on property management out of your hands, so it becomes a passive investment, which a lot of us are looking for. Then we go into our 721 exchanges. And then from there, some investors, so from your DSTs, some investors like to take the next step, and that's exchanging their DST interest for shares in a real estate investment trust. This keeps tax deferreds, increases diversification, and may offer more liquidity, all while maintaining your exposure to real estate. So keeping real estate in your overall total exposure in your portfolio.
Yep.
And
And
then
one more tool there that we can use to manage those taxes.
yeah, and the last one, that's a installment sale. And so that's where the seller receives payments over time instead of all at once. And this can smooth out income, reduce tax impact, and kind of create a predictable cash flow, which kind of helps on the planning side of things. So yeah, and then kind of to close all that and bring that together, real estate is not simple, but with the right strategy, it can be transformative, and benefit us all in certain ways.
Absolutely. So that's what we're here for, and that's what these podcasts and our information is designed to do, is to help you build clarity, confidence, and a financial life that's aligned with your purpose. Um,
This has been the Wealth Wisdom Corner. I'm with Jeffrey and Marcus.
yeah. So you all, let's keep building wisely out there. Let's keep sharing this information. Make sure you all are getting it, sharing it with people. And again, we look forward to you all participating and having us, talk about some things that you all want to talk about. We're, of course, going to hit current events, but of course, we want to get down to some of the things that are important for people to understand. So until next time, you all have a great week. Stay warm. If you're here in North Carolina, it's a little colder than we expected. Got another hint of winter here, but we're all bundled up and ready for the week. So until next week, you all have a great one. Take care. Bye bye.